Let's get to today's action. We have Matt's and Money, Zach Sheperd. Zach is saying there are two areas of the market investors should avoid at all costs. Oh, I got to hear that. Kurt Cambier of Centennial Capital Partners. Kurt's going to tell us two ways to profit in a rising rate environment. We know that's coming eventually. And Todd Horwitz is in the pits of the CME. We begin with Todd. Look, while the markets are relatively flat, it's not fair to say there wasn't any action. There truly was.
You know, the action was, first of all, good afternoon, Liz and David. The action was very muted. You know, there's a big move on the horizon here. And whether it is the upside or the downside, I can't say. I do believe it'll be the downside. I have not switched my bearish position. But the market has been narrowing. You know, we went through a couple of weeks where we had 100 points, 200-point swings every single day. Now we're lucky if we can get a 60 or 70-point swing in a day. So there's a very large move brewing here. We're right up here at the upper level of a mathematical number of 2040 in the S&P. I think that's going to hold us in, and I do look for us to go much lower. Other than the Fed guys talking again, like Greenbraun yesterday, coming out and talking about interest rates, the market looks to me like it's tired, and there should be some profit taking. Whether we get the correction or not, I'm not sure yet, but I certainly would see some profit taking here very soon. All
right. Well, Zach, I know you're not a bear like our friend Todd is, but on the other hand, there are certain things to avoid. What are they?
Well, we avoid all the time. We avoid long bonds and we avoid gold. And the reality is that if you look at just the last 20 years, gold has had about a 6% return. You look at the S&P at about a 10% return, and you have microcap stocks coming in at 13% for roughly the same amount of risk. So there's no reason to own gold in a portfolio. Long bonds, another play there that a lot of investors are doing now. You know, if interest rates go up just a little bit, they're going to lose a massive amount of money. It's going to be ugly.
Oh, we don't want to lose money, Kurt. No, we never want to lose money. So how do we make money in what we know will be a rising interest rate environment?
Well, I think you take the opportunity to look at financials and companies that could benefit from a rising interest rate environment. And some of the big companies that haven't participated yet, or maybe some of those that are in a dip right now, like Genworth Financial, had two really bad quarters, but fundamentally is a pretty good company. It's got a strong position in the mortgage insurance market. It's getting hurt right now in long-term care insurance, but it can adjust its premiums. And as it can earn a little bit more in its reserves, its profit margins can come back. And the book value in the stock is at 24. I liked it at 13, and in fact, Barron said at 13 bucks last month, it had a chance to move up somewhere between 50 and 80%. Now it's traded at 8 bucks. It's the steal of the year at that price.
Okay, so but again, it's $8 right now.
I know, that's great.
So you're saying
buy the dips and sell the rips.
Okay.
Get in. Buy the dips and sell the rips.
Do you give JCPenney any hope? I mean, they really were close to biting the dust. They did make this comeback. What do you think about it?
They're going to bite. They have no chance. They're going to bite the dust. This is going to be a very rough Christmas for a lot of people because of the lower margins because of all the deals. JCPenney, in my opinion, because of their real estate problems, because of their business model now, they have no chance. They're going out of business. The only question is when. Doesn't mean the stock is going right to zero, but they are definitely going to close their doors.
If you wanted to buy a retailer, Zach has one. You like Skechers. Skechers, of course, is a footwear company that's suddenly gotten very... How's that for a transition? A little segue there. But let's get to it. This could be a company that's a little touch and go here, but SKX, what do you love about it?
Well, I love the fact that it is a small value company. And, you know, we tilt towards small value because that's where academic premium exists. You're looking between 3 and 5% in addition to just being an equity as far as holding a company like Skechers. But you have to be careful. You don't want to just pick Skechers as a stock. You want to put it into a portfolio, a globally diversified portfolio that has over 12,000 companies in it, and hold it long term.